Welcome to today's MES discussion group event featuring Keith Spence and William Roscoe. My name is Carlos Da Costa, and I oversee the MES discussion group. Today is January 29. I'm also accompanied by Jackie Allison, Chair of MES, and Terry Orslin, who will be assisting me. Today's event is labeled the Canadian Mining Valuation Standards and Guidelines, an overview of international perspectives. A little bit about CIM. CIM is the Canadian Institute of Mining, Mineralogy, Petroleum Association. It is a non-profit technical society of professionals in the Canadian minerals, metals, and materials and energy industries. We were founded, I believe, sometime in March 1898. We are comprised of approximately 12 societies and 30 local CIM branches. MES is a society within CIM, and MES encompasses members who contribute to all aspects of the management and economics of companies active in the mining sector. MES sponsors various events throughout the year across Canada that provides industry professionals with the opportunity to share experiences, insights, and ideas on topics related to the economics, management, and financial aspects of the business. But that said, all are welcome to join us at MES. So I also want to thank our sponsor, who is IM Gold. So thank you very much, IM Gold, for sponsoring our discussion group committee events. So Terry, feel free to take over and introduce our speakers and this event.
Thank you, Carlos. Welcome, everybody, once again. Today's topic is very dear to our hearts in our industry. What is exploration property worth? What's an M&A transaction really worth in terms of currencies and dollars and valuations? Respect to expropriations, government getting involved in our properties, transactions of other sort, capital market valuations, fairness opinions, they all have the topic of evaluation. We have two distinguished guests today. They've been involved from the day one. In 1999, the committee was formed to be able to address these issues of uncertainty and clarity for the property valuations, M&As, and so on and so forth. There've been a lot of history in other spots in the world for parallel studies and comparative analysis. You will hear about that today by our speakers. And it's a process that will evolve. Probably we will say we are coming to an end whereby the question is very few elements are left, features are left, whereby we can answer for the future. But I think structural work has been done over the years, thanks to Keith and thanks to Bill Roscoe. Keith, as you know, has been around for global mining capital as a private equity investments and M&A globally. The company has extensive funding relationships with partners in Asia. He has worked through RBC, Scotiabank, BMO, various positions and for international mining transactions. As a geologist, he has been exposed to a lot of exploration opportunities and properties. He is the co-chair of the globally recognized Canadian Mining Valuation Standards and the Guidelines for Mining Projects, which is referenced by the Toronto Stock Exchange, the Hong Kong Stock Exchange, and the Singapore Stock Exchange, among others. He's also chair of the International Mineral Valuation Committee, which is MVAL. You will hear about that in a few minutes. He has published and presented mining valuation in Canada and internationally in various committee meetings. Bill Roscoe is a geologist with more than 50 years of experience in the mining industry in Canada and internationally. After working as an exploration geologist and consultant, he co-founded Roscoe Postel Associates, RPA, in 1985. He served as president, chairman, and chairman emeritus until his acquisition by SLR Consulting in 2019. He was instrumental in growing RPNA into nationally, internationally recognized geological and mining consultants with offices in Toronto, Vancouver, Denver, and also London, UK. Since 1999, Bill has been co-chair of the CIM Special Committee on Valuation of Mineral Properties, so-called CIMVAL, which is the basis of the discussion today. The CIMVAL standards are now globally recognized once again and referenced by the TSX and other international stock exchanges. He represents CIMVAL on the International Mineral Valuation Committee, and he is the past chair. Dr. Roscoe published numerous papers, presentations, and as recently as in October in Toronto, and the valuation mineral properties and mineral resource estimations bear his marks and his knowledge and his experience. He taught a course for 5 years at mineral resource exploration as an adjunct professor at the University of Toronto. And he has received the Mining Hall of Fame award a few years ago. Without further ado, I will ask Keith and Bill Roscoe to make their presentations to our audience. Thank you.
I'd like to just mention that if you do have questions for Keith and for Bill, by all means, we encourage you to add them in the chat box. And at the end of this event, we will be reading out the questions to both of them, both of the speakers. Keith and Bill, feel free to start anytime.
Okay, thank you very much, Terry, for that introduction. And thank you, Carlos and Jackie. Thank you all of you online for the presentation. Much appreciated. I will be doing the front half of the presentation, and Bill will be doing the second half. During the presentation, you'd hear me sometimes say mineral properties or mineral projects. They mean the same thing. And I might say mining properties or mining projects. They mean the same thing. They're used interchangeably in this presentation. This presentation is basically about best practices in mining valuation, and we'll touch a bit on the international scene and give you some international perspectives. Next slide. We'll be discussing what is a mineral property valuation. That's very important to set the stage. A brief history and background of the Canadian valuation standards, the international scene, fundamentals of evaluation, and Bill will do a deeper dive into the CIMVAL Code, and then some conclusions, and he will give a valuation example, and then we'll be open for questions. Next. What is a mineral property valuation? Next. This is key, and in the presentation, I'd like to say this, and another slide that will come up later is the two most important slides you should remember from this presentation. Of course, we want you to remember all that we've said, but a valuation is an estimation of the value or the worth of a mineral property. It's how much is this project worth? How much should I pay for it? Which is distinct and different from evaluation, which is an economic assessment of a mineral property, generally for investment decision. Is this a good project? Is this a bad project? A go or no go decision. Do I like this property? Is it a quality property? That's evaluation. Valuation doesn't care too much if it's a good or bad property. Valuation wants to say how much we should pay for that property. And in evaluation, the principal reports most of you would know about is the PEA, a pre-feasibility study, and a feasibility study, either a definitive study or a bankable. Next. Uses of a mineral property valuation. This is not an exhaustive list, but you can see it's quite a list. Mergers and acquisitions transactions, capital market transactions, IPO pricing, stock exchange listing support, audited financial statements, fairness opinions, private equity transactions, litigation, and arbitration. It's used a lot in this area. Government expropriation, a lot again also in this area, and insurance claims. Next. I'll give you a brief history and background on the Canadian mining valuation standards. Next. We are all aware, some of us who've been around for a while, of the Bre-X fiasco in 1997. It caused a great crisis in the mining capital markets. I think it's a seminal moment in the mining space. Most people talk about before Bre-X and after Bre-X, very much like how we talk about COVID now, before COVID and after COVID. It was really a great time of stress in the mining space. And the mining industry said we had to do something about it. So the Toronto Stock Exchange and the Ontario Securities Commission set up a task force to look into the mining space and say, what can we do to fix it? And that mining standards task force came out with several recommendations to improve the standards in the mining sector. One of the recommendations was that CIM form a committee to advise on approaches to valuation of mineral properties. In 1999, 2 years later, after Bre-X, and actually the same year as the Mining Standards Task Force report, CIM established a special committee on valuation of mineral properties, CIMVAL, co-chaired by Bill Roscoe and Keith Spence. Next. Other mining standards task force recommendations at the time included, and some of these standards you are familiar with, you take it for granted, but prior to Bre-X, we didn't have these standards. Some people use them as best practices, but they were in special cases. Standards for reporting resources and reserves. I was involved in that also, and we now know as the CIM reserve resource definition and classifications standards, which is some of you know as the Crisco standards, and Bill will touch on that in his presentation. Standards for disclosure of properties or projects, which is 43-101. Qualification of professionals, who make sure that professionals are properly qualified, and now we have what we call the QP concept. In Australia, they call it the competent person concept, which is the qualified person. Exploration best practices, we take for granted now, but wasn't necessarily the case back then, like splitting the cores, sampling of drill cores, QA, QC procedures. CIMVAL, after about 4 years of work, was issued and adopted and approved by CIM in 2003. And a new CIMVAL code was updated and approved in 2019. Next. This is just the front page of the latest updated version of the CIMVAL code. Next. The international scene. Next. CIMVAL is globally recognized, and it's becoming very much as the same way we look at, you know, I do deals all over the world. Just this week, talking to some people in Brazil and in Guinea, in Africa, and they all tell me, "Oh, I'm thinking about preparing a 43-101." You know, it's 43-101 is well recognized for standards of disclosure of properties. Very much so. CIMVAL is the go-to standard for putting a value on a project. The TSX Venture recommends CIMVAL for valuations. That's in the CIMVAL, the TSX Rules Appendix 3G. In 2007, CIMVAL signed a cooperation agreement between the Chinese Valuation Authority, CAMRA, and CIMVAL and CIM. In 2010, the Hong Kong Stock Exchange adopted CIMVAL for its listing rules. That's in their regulations called Chapter 18, which has to do with IPOs. The Singapore Stock Exchange adopted CIMVAL. And as I said, CIMVAL is the go-to valuation standard globally for valuation of mineral properties. The other standard that is used a bit, but I think we've eclipsed them now, is VALMIN, which is the Australian equivalent. And I'll talk a little more about those other global standards. CIMVAL is cited or utilized in numerous high-profile mining disputes and settlements and arbitrations. For example, the big 5.8 billion Bre-X Roscoe copper project, which Bre-X was awarded recently a few years ago, for its project in Pakistan, Baluchistan in Pakistan. Gold reserve versus Venezuela, 1.1 billion, Glencore, Crystal X, etc. Next page. On the international scene, IMVAL is the International Mining Valuation Committee. It's the international body for mining property valuations. It's very much like Roscoe is the international organization for resources and reserves. Canada is currently the co-chair. I'm currently the co-chair, and Bill Roscoe is a executive member, but Bill is a past chair some years ago. IMVAL includes Australia with their VALMIN valuation standard, Canada, of course, CIMVAL, South Africa, CIMVAL, and those three at the top are really the three top ones. The USA through SME, which is the CIM equivalent, and IIMA, which has strong valuation practice, and they actually certify evaluators, and MMSA. Then the observers are the UK, Turkey, and China. And we have a list of about 3 or 4 other potential countries that are in the process of becoming an observer. The IMVAL template also harmonizes best practices for valuations, and it draws on the main countries, Australia, Canada, South Africa, and the USA. The IMVAL template is available for adoption by national mineral valuation bodies. So any country that, very much like Roscoe, want to join the international standards will follow the IMVAL template. Next. And this is the template. And we can make that available to anybody who would like. We'll tell you where you can find it. Next, please. A little about the valuation fundamentals, and these are real fundamentals for when you're valuing a property. These are sort of best practices regardless. So next. Here we establish what is your definition of value. And for our case, for CIMVAL, and in most cases, it's fair market value. IMVAL uses something called market value, which is essentially fair market value with a little slight variations, but it's essentially the same definition. The key elements of fair market value are as follows. 1, and this is important, both seller and buyer are willing and not under any compulsion to act. So it's not a forced sale. You're not being forced to sell your project. The transaction is at arm's length. Both the seller and the buyer are informed or have reasonable knowledge of the relevant facts. And valuation should be based on the given point in time. And note that this is probably the most important point here, the given point in time. So if somebody, some time ago, I saw a uranium project that had an enormous price that was charged. The person bought it for enormous price, which looked very ridiculous. But people forgot that at that time, uranium prices were quite high. And they're looking at it currently and saying, no, that project should have never been worth that. But it's the given point in time. Other types of value include replacement value. You've probably heard about that with insurance. There's also insured value. There's salvage value, book value, depreciated value, net asset value, which a lot of my banker friends will be aware of, and assess value. Next, please. Valuation principles. These are core principles when doing a valuation. The core fundamental principle. Competence. The valuator must be competent. Materiality. All relevant information and assumptions should be provided. Objectivity. You should be impartial and free from bias. Transparency. You should try to provide all the information of the process in the evaluation report. Additional principles apply. Most of the countries have the top 4, and some may not have the bottom 2. But most of them have the bottom 2. Independence, meaning the evaluator has no interest in the parties to the transaction or the property. And reasonableness. If another evaluator looked at it, they would say, well, that makes sense. So somebody can't do a valuation on a project and say this is worth 10 million, and then somebody else through their own methodology say, I think it's worth 10 billion. 10 million and 10 billion, something doesn't match here. So that's reasonableness. Maybe if one person came up with 10 million and another person came up with, maybe 15 or 20, you might say that, it's on the high side, but still it's not 10 billion. Next page. The types of properties, and this is important because valuation is stage-based. So we segregate properties and projects into 4 main categories. Exploration properties, which is mainly early stage exploration projects. Then we have a category called mineral resource properties, basically advanced stage exploration properties, properties with identify mineral resources, properties where you have a PEA or pre-feasibility study, marginal development properties, and past producing mines. Development properties are basically pre-construction properties. So you have a feasibility completed, development is planned, and you certainly have some reserves, and of course resources, but certainly you should have some reserves and production properties. Next page. Valuation approaches. This is, I guess, most people are looking. This is the thing you're going to learn. There are 3 generally accepted valuation approaches. You have valuation approaches and you have valuation methods. We'll talk about the methods. The methods are subsets of the approaches. The income approach, based on the principle of anticipation of benefits. The market approach, based on the principle of substitution. And the cost approach, based on the principle of contribution to value. The valuation approach that you take depends on the stage of development of a property. So, for example, you would see later, you wouldn't use the cost approach on a production property. Next page. Valuation methods, they are a subset of the valuation approach. And the most commonly used is the DCF, the discounted cash flow method. And then there's also the option pricing model method, or the real option method. Or some people, there's one particular person I probably shouldn't mention here, but he uses real option methods, and he calls it the dynamic cash flow method. And this is all based on Myron Black and Scholl's seminal work on using options and to make a decision and value things. Market approach, comparable transactions method, which is you look at prior transactions and say if this transaction was X, and it's similar, therefore this might be similar. And of course, Bill is going to talk a little in his example. He'll tell you a little about that. Market comparables, it may not be necessarily a transaction, but you look at a similar property with similar resource, similar reserve, similar infrastructure, similar maybe location, and they're similar and in size, and then you can say maybe you can use that as a comparable. Option agreement terms, and another way of when a project is being purchased through option agreements, you can look at the terms of the option agreement and use that as a basis to help you in your valuation. And the cost approach, the appraised value method, used widely, but not certain aspects of it is not accepted by certain regulators. In the case of the TSX, there's a modified version. And the geoscience factor method, not widely used, but I've seen it used in other places. I've seen it used in China. Ross Kilborn, some of you probably know him. He's no longer with us, but he was a big proponent of the Kilborn method, which is basically the geoscience factor. Next page. As I said, valuation. This is the next slide. I said there are two slides here you should remember. This is our Lassonde curve. I see a lot of people using this chart. It tells you what approach should be used for which stage of development of a project. You can see it. I'm not going to go through it in detail, but the key point is for exploration property, you're not going to use the income method. And for cost method, you're certainly not going to use it for production or pre-production property. And of course, market you can use throughout the stages. Next. Now I'll ask Bill to give a deeper dive into the CIMVAL code. Bill?
Thanks, Keith. And I'm qualified to do this because I'm a qualified scuba diver, I think, so I can do a deeper dive, but not too deep. Have the next slide, please. So just to Keith has touched on some of these, but just kind of list to reiterate some of the best practices that are specified in the CIM guidelines and the standards. So the evaluator must be appropriately qualified and experienced, and that's termed the qualified evaluator, or the QV. And the requirements for QV are very similar to the requirements for the qualified person under National Instrument 43-101, that is experience and education and belonging to a professional organization. And the QV is responsible for the valuation and the valuation report and for meeting the standards. And the QV chooses which valuation approaches and methods to use and explains in the report the rationale for using these particular methods. And the standards specify that more than one valuation approach should be used. And often it's not possible to use, depending on the property, not possible to use two approaches. So if not, the value of the qualified valuator should explain why only one approach is used. And Keith has already talked about the valuation approach based on the stage of exploration or development the subject property. I won't repeat that. And generally, the valuation is stated as a range of values. And one reason for the range is because there's a fair amount of uncertainty in the inputs to the valuation and the valuation methodology itself, and so that the range and to some extent the size of the range, the separation between the high end and the low end is reflective of the uncertainty of that. And then in some cases, a preferred value is required, and it'll be somewhere within that range. And the report must specify key assumptions, risks, and limitations involved in the valuation. For example, one key assumption might be that permitting for the project will take 2 years, which, as we all know, may be somewhat wishful thinking, but that's a key assumption that's inherent in the valuation. And the valuation report may be one of two types: a comprehensive report or a short form report. The comprehensive report includes a detail and description of the property akin to that in the National Instrument 43-101 technical report, and the detail on the valuation itself. Whereas the short form can be much shorter on the description of the property. And an important aspect here is that the valuation may not be as rigorous or as at a as high a confidence level as that in a comprehensive report. Next slide. So the standards, I think Keith mentioned that the standards are rules which are mandatory, and the guidelines provide guidance and best practice which are highly recommended. And one point here is if the valuation report does not follow the guidelines, there should be a good explanation of why not. There often can be a good explanation, but it should be in the report in the interest of transparency. So the standards cover principles for valuation, materiality, transparency, et cetera, that Keith mentioned. And it covers the qualifications of the response and responsibilities of the valuators. And it has requirements also for the use of mineral resources and mineral reserves. And it covers valuation and valuation reports, what the required items are in the report. And the guidelines provide best practice for things like generally accepted valuation approaches and methods, which Keith has touched on, and the use of mineral reserves and mineral resources, and the table of contents for valuation reserves in a little more detail than specified in the standards. Next, please. So Keith touched on the CIM definition standards for resources and reserves, and the JORC code in Australasia, and the SAMREC code in South Africa, and the SME standards and so on, are all part of CRISCO. CRISCO is an umbrella organization of many countries that come up with standard definitions or reconcile differences from other standards in other countries together so that they can be used by anybody. And in general, a mineral resource is a mineral deposit for which the tons and grade are estimated, but has not yet been demonstrated to be economic. Whereas a mineral reserve has been demonstrated to be economic by a feasibility study or a pre-feasibility study. So I think you're probably all familiar with the categories of mineral resources: measured being the highest confidence, indicated being also high confidence, and the inferred being the lowest confidence category. And even though it's not demonstrated to be economic, the resource needs to have demonstrated reasonable prospects for eventual economic extraction. Otherwise, it's not a resource. Whereas a mineral reserve has the economic viability that has been demonstrated, and the proven reserve is a higher confidence category, and it is derived from measured resource, and a probable reserve is a lower confidence category, but still relatively high, that's derived from indicated and or measured. Next, please. So the CIMVAL guidelines provide generally accepted practices for the use of mineral resources and mineral reserves in the income approach, which is generally discounted cash flow analysis. And it specifies or it allows the use of all proven and probable mineral reserves, which are generally all used in a discounted cash flow analysis, and the use of mineral resources under conditions. The measured and indicated categories, which are the higher categories, can be used if they're current, and this applies generally for the use of resources and reserves. The reserves should be mined earlier in the mine plan and in a cash flow projection ahead of any resources, including measured indicated. I'll talk about reserves in the next slide. But there should be some sort of confirmation by the qualified person or qualified valuator that the mineral resources are likely to be economically viable. This is more likely covered by the requirement for reasonable prospects of eventual economic extraction. Next, please. So the use of inferred resources are somewhat akin to dancing with a porcupine. That is, they must be used with caution and great care, particularly if they're the dominant resource category. Inferred mineral resources are often used in discounted cash flows in preliminary economic assessment, which is the lowest level of economic evaluation that Keith referred to earlier, because they're not allowed, inferred resources are not allowed to be used in the cash flow in a pre-feasibility study or a feasibility study. So if inferred mineral resources are used, they must be mined in the mine plan at the very end, after all mineral reserves and after the other categories of mineral resources, since they're the highest risk and the most uncertainty, and they should be treated by some sort of consideration to recognize the risk and uncertainty. And this can be by only using a part of the inferred resources, or perhaps by applying a higher discount rate to account for especially if the inferred resources are a large part of the resources in the cash flow. So, and I think you really have to justify using inferred resources to make the property economically viable. There's another category of material that gets reported, and that is potential resources, or sometimes called target for further exploration. And it's not acceptable to use these because of the high level of uncertainty, and they're quoted as a range, and they're not allowed under CIMVAL anyway to be used in evaluation for hypothetical resources. Next, please. So this is just a list of some of the issues and problems with mineral property valuations that pop up from time to time. The use of unacceptable or dubious methods. I think that the CIMVAL guidelines specify what are generally accepted practices, and so if there are practices that are not included on that list, they may or may not be unacceptable. And one example there is the use of hindsight, where a property may change hands or transact after the effective date of the valuation. Keith emphasized the importance of the valuation date, and you're not allowed to use that hindsight information in the actual valuation that predates it, other than to perhaps use it as a check of the valuation that's been done. Misapplication of acceptable methods, that is, I just gave an example of use of potential resources in the DCF. And if there's no explanation or justification for the methods used, maybe a shortcoming and a lack of transparency. And if the valuation doesn't seem reasonable, that's the reasonableness test or the smell test. Evaluators who have been around for a while, experienced evaluators will have a lot of knowledge and have seen a lot of different things, and they get a pretty good idea of what a property should be worth, and so that would be the so-called smell test. Lack of transparency, there may be a lack of explanation on the methodology that's used, and lack of justification for the methodology. There'd be lack of transparency. Or if the evaluator is not independent, not at arm's length to either party in the transaction, or is not appropriately qualified. They may be qualified, but not necessarily qualified for the particular commodity or type of deposit that's being valued. And a lot of these things come under the category of, trust me, I'm a valuator. Next, please. So I'm just going to kind of read the conclusions here. We've just touched upon everything, I think, in the presentation. CIMVAL is recognized nationally and globally recognized, and it's often referenced in litigation and international arbitration cases. I mean, in these, it's very important here because in these legal cases, there's often the judge or the arbitration panel doesn't have direct mining knowledge, and so they need something to refer to and to make a judgment on the testimony of expert witnesses on both sides against. And so they often use the CIMVAL or the Australian valmen to put the testimony into perspective. The fundamental principles must be adhered to. Qualified valuators responsible for valuation and the valuation report, and the CIMVAL guidelines specify valuation approaches and methods for mineral properties at different stages of exploration or development. As Keith mentioned, this is very important. CIMVAL includes guidance on the use of mineral resources and mineral reserves in the income approach, and the International Minerals Valuation Committee provides a valuation standards template for use by any country that chooses to have a national association for valuation adopted. Next, please. So on the final slide here, I've just put together an example of a valuation that might be carried out by an independent valuer. It's a property we're using as an example of resource stage gold property in central British Columbia. The resource is 2.5 million tons at 6.5 grams per ton, containing about 522,000 ounces of gold. And it's fairly well located with road access and a power line not too far away. And it's had a preliminary economic assessment done on it, which uses the income approach to come up with a net present value of $40 million at a 5% discount rate. And as we know, the 5% discount rate is kind of the standard that gets used for gold projects and PEAs, but it's probably doesn't have much validity in the real world of valuation, in my opinion. And so the qualified value used a higher discount rate here. He thought 12% was appropriate to obtain a lower net present value of $15 million. And the evaluator's also done evaluation using a market approach, comparable transactions analysis, whereby he or she has collected data on a number of transactions that predate the valuation date and come up with a range of values that from $15 to $20 per ounce based on, say, 15 similar properties that have been analyzed to come up looking at the average and median values and so on. So when this $15 to $20 gets applied to the 522,000 contained ounces, it comes up with a value of 7.8 million to 10.5 million. So we've got two different valuation methods that have been used to put a value on this property. They're not the same, so we need to reconcile these two methods to come up with an opinion of the value. So in this case, the evaluator thought that each approach had equal validity and has chosen to weight them each at 50%, which is just basically the average of the values to give a range of 11 million to 13 million. So that's it. Thank you very much. Any questions?
Okay, so again, as I mentioned before, if you do have questions for Bill and Keith, I do encourage you to add it into the chat box and we will read them out to them. And so the first question is from Anne, and she says, does prospective buy versus seller matter? Buyer versus seller matter?
Keith, you want me to answer that one? I guess the answer really is it shouldn't, but it does.
Okay.
I mean, the evaluator is supposed to come up with an independent, objective value, but as we all know, in the real world, that doesn't happen, I think. But I think that, to be fair, there's a lot of opinion and assumption involved in evaluation, and it depends how much weight you put on certain types of data and so on, so that there's a fair amount of latitude in the way you can value a property.
Okay, now, thank you. Now the second question is from Rodney Cooper, and he says, a senior gold company just sold a mature producing asset for 425 million US to a much smaller company. The buyer valued the same asset at approximately $1.2 billion US. Can you discuss the differences in value perspectives between a senior and junior companies?
I think that yeah, junior companies and junior companies and senior companies look at valuations and value of properties in a different way and for different purposes. I think that senior companies aren't quite so concerned about what their market value is, whereas junior companies are very concerned, so that their objective is to get taken over by a senior company or sell their property to a senior company to cash out, and so they're trying to maximize the value. Whereas I think that a senior company, and so I think I mentioned the PEA at 5% discount rate. Well, that's one way of trying to get a high value for your property. But a senior company will look at things from a different perspective. They're going to say, well, what is this thing really worth? Or can I make money from this particular property? So they're gonna take a look at something with say a more realistic point of view. They're still going to try and get the best price possible. But I don't know if that answers the question.
I think it does. Okay, next question from Anne. Okay, an aside, but are there Canadian coal resource definitions also when last revised?
I don't have an answer for that. I'm not a coal expert, so I'm not. Although I have done valuations of coal properties in conjunction with other people, but I don't think I can answer that question.
Okay,
Maybe somebody.
And Andre Gauthier asks, how is CIMVAL compared with JORC?
Well, CIMVAL and JORC are two different things with two different standards with two different purposes. CIMVAL, you've just heard all about now. It's all about valuation of mineral properties. And I might specify not mineral companies, because corporate valuations are a different subject entirely and is not covered by CIMVAL. But the JORC code is analogous to the CIM resource and reserve definitions. It's the Joint Ore Reserve Committee. That is what JORC stands for. And so it gives definitions of resources and reserves that are very similar to the CIM definition standards, and they both fall under the CRISCO, or they both adhere to the CRISCO framework.
Next question again is from Andre, and is CIMVAL, is it also included in CRISCO?
CIMVAL?
Yes.
No, it's not. No, CIMVAL is about valuation, whereas CRISCO is about resource and reserve definitions standards. And but the IMVAL is really an analog to CRISCO for the valuation scene, and so it's an umbrella organization that has several, as Keith mentioned, several from 4 countries and other observers, members of valuation associations or groups like CIMVAL and Valmin in Australia and so on that belong to that. So it's a parallel organization. I mean, it's at an earlier stage than CRISCO was, but it's a parallel organization for valuation standards.
Okay, I believe that Brian and Pierre chimed in to answer Andre's question, and Brian says CRISCO and JORC are used for the standards of disclosure of mineral resources and mineral reserves. Valuation is separate from resource reserve estimation, so they are not comparable. Pierre also mentions that I think the question Andre meant to ask was to contrast CIMVAL Canada and Valmin Australia.
So that's Pierre. That's my colleague Pierre's question.
Yes. Yes.
Okay. So yeah, well, I mean that is a fair question, I think. I mean, you've heard about CIMVAL, and Valmin, I think, is from what I understand, a little broader in its scope. I think it also contains standards somewhat akin to 43101 for reports in general, technical reports in general on mining projects, but it also includes standards for valuation. If you look at Valmin, you'll see you'll see that the box diagram similar to one that's almost the same as the one that Keith showed earlier for valuation approaches at different stages of exploration and development and so on. So.
Okay, so Michael Hitch asked a question. Monte Carlo simulation and probabilistic modeling are the basis of optionality. Comparables also work. So I'm not sure which questions you're referring to for that one. Next question is from, let me just see, Pavian. Okay, no, that's not a question. Then Michael Hitch is saying cost per unit value, etc. Andre asked another question. How to be a QV?
Well, I think that, you know, you can have the, I think the first step is to belong to a professional association such as Professional Geologists or Professional Engineering Association in Canada or equivalent internationally. And you can have, you know, education is a bit of a conundrum, I think, because there aren't that many educational opportunities in valuation as far as I'm aware of. I don't know if there may be courses, but so I think the way to do it is to a couple different ways to get educated. One is to, you know, attend workshops and seminars and so on, and there's a lot of literature on valuation out there to become familiar with that. But more importantly, probably to be mentored by a valuation professional or qualified valuator and go through that route, and then experience, of course, you know, just doing it, just on the job experience for a few years or whatever it takes.
Okay.
I'm back on. I think
good.
you can see here.
Good.
Yeah.
So am I, by the way. Can you hear me?
Yeah.
Yeah, perfect.
Okay.
Okay, next questions from Anne. In the DCF method, cash flow pre and post-tax inflated or current dollars, range of acceptable discount rates.
Hey, Keith, I've taken
Bill,
the first
okay,
five questions.
maybe I'll just say that. I heard Bill, I was trying to get on, and I heard Bill was talking about in his example, he talked about the 5% that everybody uses. I think that the use of the discount rate, we all know it will affect the valuation, the NPV significantly. So generally, you should try to use the discount rate to account for the risk. So if you have a project in some high risk country and it's an earlier stage project, you'll definitely want to use a higher discount rate. Certainly not 5%.
So that, okay, I'm gonna ask a question because it's popped into my head. When we look at the discount rate, do we not start with the WACC, which is the weighted average cost of capital, for that project itself, and then we tag along any risks associated with the project itself?
Yes,
right?
yes.
Make it a little more conservative.
Yeah.
So shouldn't you be starting with the WACC of the actual project itself and then adding any relatable risk associated with the project?
Yeah, that makes sense if you have you're dealing with a project, sorry, a company. But remember,
you can still do.
Yeah, but let me just finish. So the WACC is the base point, and that makes sense, starting with the weighted average cost of capital, and then you could add a premium or a discount.
Yeah, because you can actually come up with the WACC for the project itself, right? You're not necessarily going to use the WACC of the company, right?
Yeah.
So you can use that as a starting point and then add, you know, any risks associated and any expected return that you're seeking out of this project itself. So making this more of a conservative methodology.
Yes, and some people would just use what they see other people are using. One of our MES members, Larry, does a survey every 3 or 4 years on discount rates and try to get an aggregate rate of what people are using. Right now, a lot of people are using 5% on early stage, late stage. I think is ridiculous. It doesn't account for the risk.
But I'm gonna be the devil's advocate when I say this, right? Isn't that a little bit of a lemmings approach, right? You follow the herd kind of thing, to get a more descriptive
Yeah,
understanding of what the discount rate should be. You have to
yeah.
look at the factors associated with that project, not necessarily the average of the industry itself.
Yes, I agree. I agree. I'm just telling you what he does
Oh, no, I'm not.
to
I'm just
see what's
saying. I'm
going
just
on
saying
in the
from your
industry.
own
Yeah.
opinion.
No,
So,
I was gonna shut up, but I'm just gonna step in here. I said, and say, I think that my opinion is 5% is too low,
yeah.
I think that we're maybe getting a little into the weeds and off topic here. I think that,
Okay.
we're talking about standards and guidelines. I think
Yeah.
and it's easy to go down the path of talking about specific methodology and what different people do and different companies do and so on. But
No, I totally agree.
it's a whole interesting topic, but
it was just curious to me because, when I was thinking 5%, just like Keith was saying, it's a little bit too
It's a
low.
joke. It's a joke to use
Too low.
5%.
That's
Yeah,
exactly
way
it.
too low. Way too low.
And that to me is a little bit of a blue sky methodology.
And we all know in a DCF the interest rates is a key determinant.
Exactly.
It's very, 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 very influence the number very, very, very much.
Okay, so that leads to the next question from Claude. Okay, and Claude asks, QV is similar-ish to QP, so are QV restricted to evaluating projects in which they have at least 5 years of experience, i.e., gold veins or iron ore deposits versus industry minerals, or is it a bit less restrictive?
I would say it's a bit less restrictive. I think 5 years experience, but not necessarily in the commodity, because if you're doing gold and iron ore, you don't need 5 years. That's 10 years experience total, right? 5 in each. But I think 5 years experience in valuation with some experience in the commodity.
Okay, great. One thing I'm amazed right now because I'm looking at the numbers. Uh, in the last 5 minutes, there's 20 new questions. Okay, so it shows there's a genuine interest in the subject matter. So if you guys have the energy and the breath, I think we'll continue on. You can tell me to stop anytime. Okay. Another question. Is I'm not sure what is it conversion factors for resources.
Well, again,
I
that
guess
may be
that's a resource. That's not a valuation issue.
Yeah. Okay. Just wanted to clarify that one. Okay. Next question. I believe Pierre basically responded with regards to the QV question, and he states that QV must be a member of a professional association, example, an engineering or geoscience regulatory body or a self-regulatory professional organization. If the QV lacks expertise in certain aspects, they must seek assistance from other qualified valuators or experts.
That makes sense. That's correct.
Anyway,
Okay.
there's a follow-up question saying that if a QV has ever been sued for their valuation provided.
I don't know if I can. Not that I'm
not aware of
but I
anybody
know
who's been sued for valuation.
I've
I've
heard of QVs being called various names, but I'm not sure if they're.
and I've seen a lot of spurious evaluations. So that doesn't make sense. I've seen a lot. Yeah, I've seen a lot. Trust me. Yeah, but
Okay.
I haven't heard anybody being sued for valuations yet. But a
Okay.
lot of QVs are QPs.
Mm-hmm.
Yeah, right.
Okay, the next question, should closure and reclamation costs be included in a DCF valuation?
Yes.
That's-
Again, we're getting into details of
Yeah,
methodology, but
yeah.
I think they should. That's my opinion. Anyway.
Okay.
I have a quick question, Carlos. Let me ask this. Since AI came into some sort of a reality, and which is digital data from, we have lots of data at the mine, geology, whatever. How does that play into the valuation, the data, the digitized data that mine has or the property has?
Actually, that's a very good question, Terry. I think in the future you can use AI for market comparables and property comparables. Basically it's going into a database and looking at things and coming up with I think it will be very, 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 very helpful with respect to comparables. I'm not sure for the other two aspects of approaches, the cost and the income, but definitely for market comparables.
Okay, thanks.
So next question from John Gravel. CIMVAL is recognized nationally and globally, but how can then enforce those items labeled mandatory?
Well, I guess it's up to the reader to question the whether the standards are followed or not. To question the QV. I mean, the QV is by virtue of being a QV is required to follow the CIMVAL standards. So that can be questioned, I guess.
Okay, thank you. Next question from Surya. And Surya asks, how soon before CIMVAL develops standards valuation guidance for real option valuation methods? What would be required for such a standard being adopted? Just as an analogy, the IFRS adopted the Black-Scholes method for valuing options on a company's balance sheet in January 2005, even though it was first published in 1973. Side note, by then, actual participants in options market have stopped using the basic formula adopted as the standard by IFRS.
You want me to take that, Bill?
Yep.
Yes. CIMVAL would not go into the details on methods, but maybe that is something for somebody to consider in the future. Real options is not used as much as DCF, but I could see in the future, sometime in the future, someone thinking about adopting some kind of standard for real options, but I don't see it in the near future. CIMVAL looking into that, because CIMVAL doesn't go into the details of how you should do each one of the methods.
Okay, thank you very much for that one. Pavan asks, FY corporate value incorporates the national net cash position and securities of the company onto net projects value. Henrik asks, how is the existing experiment installations of producing property valued?
What's that?
Could you-
I didn't quite get that.
Okay.
Repeat the question.
Yeah, Henrik asks, how is the existing equipment installations of a producing property valued?
Yeah, well, that would be, I mean, the valuation of the property would be a bit of an abstract thing. So, I mean, if you'd be looking at income, and I don't know how the
Mhm.
value, and that would be maybe a separate valuation. That would be real property as opposed to, the mining rights
Yeah.
that were being valued. So I don't know.
Maybe the same kind of just remember, in valuation, there's each industry has its own sort of little, the basic valuation is basic for most industries, but each industry has its little peculiarities. Real estate, for example. So maybe valuing the equipment. I think Billy was talking about the equipment at the mine site. That equipment is, I guess, somebody in the equipment field who can value equipment, maybe tractors and caterpillars
Well,
or what they were. Yeah.
Yeah, I can see that happening. Like
Yeah.
if the mine shuts down and they decide to sell all the equipment, then there are professional appraisers of equipment
Yes.
and so on. But
Yeah.
if it's an essential part of maintaining the operation for the purpose of producing income, then it would be part of the valuation of the property itself, would it not?
Yes. Yes. Definitely.
Alfina and Pierre chimed in with regards to Henrik's question, and Alfina says that current equipment carries a residual value which is generally captured in the cash flow model. Pierre says that depending on the stage of the property being valued, example, inactive past producer, you may also have a separate valuation of the equipment that is separate from the valuation of the mineral rights and property.
Yeah, that makes sense.
Okay, good. Okay, so Michael Hitch chimed in with regards to the discount rate being quite manipulative, which should actually be using the cost of capital. So he's basically supporting what I said. I teach an engineering economics course, and this is a really interesting discussion with students about what the discount rate should be. I always tell them you start with the
With the WACC.
exactly. Start
You start with
not the
WACC.
WACC with the company, but start
Yeah.
with the WACC of the project, right?
Yeah.
And then you adjust it to the risks associated with that project and any other variables that you see fit, right?
Yeah.
So that was that. Okay, Jim Turner.
Well, hi, Michael.
Yeah,
Go ahead.
okay. Jim Turner asks, how does infrastructure increases the value of exploration properties?
Well, I think that if the property is close to infrastructure, then it's going to be less costly to put it into production, and so that the economic threshold would be a little lower than a property that's very remote and that would have to have infrastructure installed at a higher capital cost. So there would be differences in the capital cost and the operating cost too, if it's a remote property versus one that's close to infrastructure. So if given the same property in two different places, the one closer to infrastructure would be a higher value.
Yes.
Yeah. And Steve chimes in with regards to WACC, and he basically says WACC is the base point. DR is not a risk number. Risk adjusted WACC is different still. Michael chimes in again, and he said you should have to quantify the risk elements, which is crazy difficult to do. And I totally agree with that. And there's also
I should just mention, and
Yeah.
we were planning to have sometime later this year a seminar or workshop on valuation. And one of the things that we're planning to do is to quantify some of these, what you're talking about, these intangibles. Basically, what you're getting at is, how do you quantify if there's a severe environmental risk? How do you put a price on political risk?
Yeah.
Why is a project in Guinea you should have a higher discount rate than say one in Ghana, two African countries, or Peru versus say Chile, or Ecuador versus Chile? And there's ways to do that, and people do it out there. The bond markets have a way to do that, but there's ways to do these intangibles.
Yeah, but the problem with these intangibles, the way they are right now, there's no standardized way of doing it, right? That's the biggest issue. Yes, there is models out there that you can quantify these various risks and so forth.
ESG
right?
risk, how you quantify ESG risk on a project?
Exactly.
Especially the social risk.
Exactly. And so that's the biggest thing when you're trying to determine what is the actual discount rate that the factors in all these risks, right? Is how reliable are the quantification of these particular risks, right? I can understand how to do the actual WACC. That's pretty straightforward. But the risks that you want to tag on to the discount rate, that's a little more challenging.
And I think Bill mentioned in his presentation, I'm almost sure he did mention that there's some judgment at the end, right?
Exactly.
Either a premium or a discount. You
Yeah.
use your judgment.
Yeah.
So I got a question to Phil here. In talking about intangibles and political risk and all, there's also accounting issues.
Mm-hmm.
The way mines are accounted for in different jurisdictions. For instance, I mean, we're dealing with half the world's consumption, production, so on and so forth is from China. Any Chinese transaction, which I noticed, the accounting that they have for their assets is completely different than our balance sheets. They actually tag along anything they spend for their shaft and for their crosscuts and the draw and the added and so on is in the balance sheet as an asset. Okay, so how do you deal with that? The accounting differences to that extreme versus adjustable issues that to negotiate, because all their mines are essentially not expensed or amortized. It's essentially showed up in the balance sheet as an asset.
well, maybe Bill wanted to talk about this, but just one key point. CIMVAL values projects, properties,
Yeah.
mineral properties, not companies. So if you are valuing a company, you might take an aggregate of the projects. But CIMVAL is not valuing the company, it's valuing the project itself.
No, I'm asking not
Yeah.
because of CIMVAL, but because the way we're trying to standardize and homogenize the
Yes.
valuation standards around the world. That's the question.
Yes, and I see a lot of the Chinese in the way, you know, I've spent a number of years, quite a number of years in China, and they still look at the way they look at things is a lot different from the way we look at value, and that's why a lot of times they look very long term. That's why a lot of times they could compete in a M&A transaction.
Okay.
Okay.
Let me just read the next question. Bear with me for a second. Okay, bearing in mind the difficulties and variabilities of values that can be assigned or estimated for a property or project in the public record, has a QV ever been sued for the valuation provided?
That's the question.
Well, I
I
think
think
we had,
somebody asked that. Somebody asked
sorry.
that before.
We had that
Oh, you
question
apologize.
previously.
Yeah.
Okay, so let's move on to the next question. Okay, next question. Okay, I'm just going forward with things. Okay, okay, dear. Okay, so I've got Alfina, and she's basically saying, "Dear MES, thank you for organizing this call, and huge thanks for Bill and Keith for presenting." So shout out to you both. Simon asked a question. Revenue is generally the number one sensitivity of all mining assets. How do you deal with with large ranges in metal prices estimates? For example, say from 1,000 units to 5,000 units, where the implication of the resources underlying the DCF are also massive order of magnitude, and thus the implied DCF value can range from 0 to trillions. Is option and Monte Carlo scenario expected risk distribution the only way to narrow the reasonable range of value? If so, how does one get comfortable support EV outcomes outcome distribution, or is a very large range of value also acceptable given the underlying uncertainty in metal value? That's a huge mouthful.
That's a mouthful. All I can tell you is Monte Carlo simulations are acceptable.
Okay.
That's acceptable, and probabilities are also acceptable. That's all I can tell you.
Yeah, I think that the qualified valuer has to evaluator has to make a judgment on metal prices, I guess, and that you know, if there's a range of and usually they try and have some basis, like one of the professional organizations that does metal price forecasting or so on, you know, or that type of thing, to come up with or consensus prices, and to come up with, even if you come up with a range of what you think the best estimate of metal prices going forward is, then you know, it may well end up with a range of values.
Okay, so the last comment, okay, actually two of them. Anne basically says, "Good work, Keith and Bill. Many thanks." And Sarah has it's not a question, it just contributes to discussion in the comments, okay? 5% is not adjusted for inflation, as typically the cost and commodity price for the top line are maintained at one level as well. Adjusted for inflation, the nominal discount rate would be higher. It's a good idea to see what rate of interest or nominal mining finance company firms, banks are lending at the fund mine development. The cost of equity over the same period should have equity risk premium added to that. Another way in which investors adjust for a 5% discount rate used for arriving at a NAV is by using a multiple to adjust the NAV downwards or rarely upwards. Okay, Lewis So that's basically his comment. Louise basically says must go, but thank you very much for the conference, and thank you, Keith and Bill. Okay, Steve King is basically saying risk using a frequency and severity matrix and estimated capital intensity. One can provide a quantitative factor of capital at risk, and therefore the impact of valuation, the difference, risk. That's a question. Okay, so he's basically saying using frequency and severity matrix and estimated capital intensity one can provide a factor of capital at risk and therefore the impact on valuation, the difference, question mark. Risk can be valorized through probability and capital. Any
Keith?
comments on that one?
That's a mouthful. I'm not sure. Sorry.
I guess if the methodology can be justified and shown to be a valid methodology, then, you know, explain it in the report.
Okay. Bear with me for 2 seconds because I have multiple windows. Okay, I'm just gonna, well, thank you very much, Bill and Keith, for the question. I think those are the questions for today. But before we go, I want to just share with everybody a few things. So bear with me for 2 seconds, okay? As long as Bill and Keith are comfortable, do you guys mind if we upload the recording for
Yes.
this presentation?
No, that's fine. That's
Yeah.
fine.
Okay. So thank you very much, Keith and Bill. So my suggestion for everybody in the audience at the moment, if this event interests you and you'd like to review the video, I highly recommend reviewing our website at MES, right? Management Economic Society, right? It's CIMMES.org. So if you go here on the top where you see national, where I'm pointing right there, national in the menu over here, you see national, Montreal, Toronto, Vancouver, and so on. Click on national. Okay. On the right hand side, you will see another menu, right? And click on highlights from past CIM MES events. What we do is we archive all of our events. If we get permission from our speakers to post the videos, right? We do that right here. So if you want to go through this list of past events and you want to see a video of a past event that you either attended or missed, they're here. You'll see here by simply clicking on these video links, you'll have access to these videos. What we're gonna do is for this video, we're gonna be posting it here very soon, and it's gonna be featured here on top. So I would estimate within a week or a bit. Do check out our website, CIMMES.org, and do check out this webpage, and the video should be posted here. For those interested in getting to know more about MES, I highly encourage you to review this website. There's a lot of informational pieces in here for you to access. For those of you wishing to contribute to MES, I would encourage you to go here where it says contact us. Click here and then just fill this out, right? And ask, and include your message. So if you have a questions for us, or if you wish to contribute, and what I mean by contribute is if you wish to become a MES volunteer, we're always looking for individuals to help us do what we do. Like we do quite a bit of things throughout the year within MES, and the reality is it takes people like yourselves and ourselves to make these events happen. So if you've got the time, the energy, and the interest, I'm encouraging you to become a MES volunteer. And all you simply have to do is fill this out, let us know, and we will contact you, and we will get you busy within MES, okay? And also, these discussion groups events that we host, right? We bring wonderful speakers. We have ideas as relates to what we should feature. But if you've got ideas in terms of event themes, or if you can suggest notable speakers, by all means, we encourage you to contribute that way. So fill this out, let us know, and we'll get back to you with a reply. Okay. Before we leave, I want to give a shout out to both Bill and Keith. Thank you very much for today's presentation. Great job as always. We had approximately 140 people online today, so that was a huge number. So kudos to both of you. I also want to give a shout out to both Jackie and Terry for assisting in making this event happen. I also want to thank out to our audience. Right. And if you enjoy these events and you're not in our mailing list, do fill out this, contact us and ask to be put on a mailing list, and we will do so. We do not share the mailing list with anybody. We're not trying to sell you anything. So in other words, if you give us your email materials, I mean, your email address, we will not share with anybody. In other words, you're not going to get spammed. Okay. What you will get is updates as to upcoming events within MES and possibly even from CIM, and it's up to you to decide whether you want to join us on that particular day or not. I also want to thank our sponsor, IAM for contributing to make this event a reality. So thank you very much for everybody, and looking forward to seeing you in our next event in the coming weeks. So just keep an eye on in our emails, and you'll get notification of our next event. Thank you very much, and have a lovely day.
Thank you, Carlos, Jackie, and Terry.
Thank you.
Yep.
Thank
Thanks for
you.
the opportunity, and it was
Yep.
good. Lots of good questions and comments.
Yes, I agree.
Thank you.
Sure.
All right.